Well, let's solve a delta chart. Now this particular section, which is the intermediate term delta, this is going to be the most important section out of all the other sections. This is where we're going to go through and solve a time frame from scratch, and it will relate to every other time frame. So whatever you can do on one time frame is related to every other time frame as well. So if you can solve this for the intermediate term delta, then you can solve it for the medium, the long, and the super long, and the short term delta. One thing I will not be doing here is going through the short term delta, because it's to do with intraday data positions, and because of weekends it is very, very hard to do. There is no point in spending the hours and hours doing this, because at the end of the day, if you want to make money, intraday is not the way to make it unless you really, really know what you're doing. I'm going to start now by bringing up a chart. So the first chart I'm going to bring up the S&P 500. And we'll solve this chart because it's a major index. Most people who are trading using things like spread betting will trade one of the major indexes, either the Dow Jones or the S&P or the FTSE 100 index. The indexes are all part of the same group. Now you'll find later on in the book there is a section to do with family groups. That particular section is in page 97. What it means is, if you go and solve for this particular market, the S&P 500, if you solve the delta solution for this market on intermediate, it will be exactly the same solution that's used on something like the Dow Jones as well as the FTSE 100. You could also use it on the DAX in Germany. All the major indexes have the same solution because they are indexes. Now, they're indexes of stocks, the top stocks of that country. There is also another index called the NASDAQ 100, but that is an index for technology stocks. So this is an index for bog standard shares. NASDAQ is to do with technology, so it actually has a different solution. What you will also find is things like banking. So if you can solve a solution for Barclays Bank, it will be the same solution as used for HSBC, same solution that's used for Lloyd's. All it is doing is giving you a position in time of where the market is likely to turn. Now, if you do a solution, let's say for example on Barclays Bank, and you're due for a high this week, then the high could occur on Monday morning. But for another bank like HSBC or Lloyd's, for example, HSBC might have a high instead on Friday. So although the actual points are in exactly the same place regarding the same time, the fact is they will turn on a different day. Now you'll see this later on as I explain everything else. So let's start off by taking this chart, which is simple daily bars of open, high, low, close, and I'm going to split them up into the delta time frames. So we need to put some coloured lines here. Now what we're going to do is draw a line on every day of a full moon, and then we're going to colour them in a particular rotation. Now in this dynamic trader we have the ability to be able to do that now under this button here called a date C. So what I do is I select this, and I'm going to select the delta ITD. These particular templates, by the way, are all downloadable again from our website. I then select that, say OK to that, and apply it on the screen by clicking here. Right, now these lines, as you can see, they're coloured. This one's red, this one's blue, this one's yellow, and this one's green. Then it repeats: red, blue, yellow, and off the screen green. Intermediate is based on every 4 lunar months. So quite simply, from this red line here across to this red line here is 4 lunar months. And then it is repeated again. I can go into the future. Bring the screen in a bit. So whatever happens in this area here will also happen in that same area there, and again in the past. So whatever happens again in this section here is repeated in this section here. Now it's repeated exactly, but there is one issue, and I'll show you what I mean. Get rid of these. Don't forget this is the same on every single other time frame as well. I'm going to zoom in and bring it up a bit bigger. Right, starting this low point here, we are looking for a low, a high, a low, a high, a low, high, and so forth along, from this red line to this red line. Whatever happens there is repeated from here onwards, same as in the past, is repeated. Now there are a certain amount of high and low positions. It's the highs and lows in time that are repeated. So even though we're saying from this red line to this red line here, which is the period of 4 lunar months, there are a certain amount of highs and lows, and those highs and lows are repeated in the next 4 lunar months. Just the highs and lows. I'm not looking at the size of a move because that's price. I'm looking at the time. So what I'm looking for is a turn in time. There's a low here, and I'm looking for a repeat of that low in the future, in the next block. This low, I'm going to give it a number. So I'm going to use here, I'll put number 1. Move the screen down a bit. I'll put it to the bottom of the screen there. Number 1. We'll thicken the bars up. So that number 1 there, which came just after this red line, I want to see it repeated in the future. And it is repeated there. So just after this red line there was a low position. It's a few days after the red line. I want to see a repeat of that low a few days after this red line. And a few days after there is a low. Now the issues are, this point is due here in time, but it also has a plus or a minus of a couple of days accuracy. So this point on average will probably occur about where it is now, but it can come as early as here or as late as here. This is the area of turn. Remember, it is the area. Same over here. It could have come as low here, or it could have come here, but it came in approximately the same place. If you look at it, you'll find it's 1, 2, 3, 4, roughly 5 days after that red line. Here it is 1, 2, 3, it's 4 days. So that's 5 days after, that's 4 days after, and that's quite accurate. Sometimes you'll find that point will come here 2 days before it's due, and this point will come 2 days after, making it look as though it's 5 days different from here to here. And this is the biggest problem people have with Delta, trying to solve a chart from scratch. They don't look at the logic of what's going on. The average point is where we expect it to be, but it can be plus or minus a couple of days. Now there is also a way of getting around this plus or minus to a degree. If the bigger trend is up, then a low point will tend to come early or on time. That's if the bigger trend is up. So if its average point is here, if a bigger trend is up, then the chances are it will come here, or it will come up to 2 days early. So chances are it will not come in the other 2 days after. So it's plus or minus a couple of days every single time. This is also where the issue occurs with certain other stocks within the family group. So I know this is for the S&P 500 index, but let's say this was a bank. That could have been Barclays Bank's low. But you would have found that maybe HSBC had the low here and then started moving up, while Lloyd's would have had it over here. So again, it based on trend, and it depends on also which particular item is within that the group. So once you've solved this, this point 1 here is fixed full stop for this S&P 500. It will also, in this same area, plus or minus a couple of days either side, will be the low for the FTSE 100, and it will also be the low for the Dow Jones. It won't necessarily be the low for the Nasdaq, because the Nasdaq is a different group. It is to do with technology stocks. It is not the normal index for bog standard stocks, it's technology. But you'll find it will be very close, because again it's an index overall. It will still have a similar-ish pattern, but it will still have different highs and lows at different points. So I've just put a number 1 here and number 1 here. That gives you 2 particular points on your screen. Now the next main position you can see is a high here, then there seems to be a low here. So I'm just looking at these little pivots around. So let's put some more numbers in. I'm going to put a number 2, and we'll put that up high there, and then we'll put a number 3 in as well, and I'll put it there. So it looks like we've got 3 simple points which are occurring between this red line and this red line, and I expect these to be repeated into the future. That's what I expect to see. Now, if we see the point 1's here, then the next high, which is a 2 here, looks as though it's probably there. So let's put that point 2 in. When you first solve a chart, it doesn't really matter. Just play around with it until you get a solution that fits. And you'll be able to find out if that's the correct solution by looking backwards and forwards into history. If you take from this red line to this red line as one cycle, what you need to do is approximately 8 of these. Do them 8 individually and then put the sheets on top of each other, or check the charts either side, and you'll see these points continuously repeating. As long as they're repeating every time, then you've definitely got a delta point. Now there are some rules to how a delta point is figured, and quite simply it states a delta high is the highest high between 2 delta lows. You'll find this information again is on page 77 of your delta book, starting from page 76, which is to do with the intermediate term, but it will tell you on page 77 again, delta high must be the highest high between 2 delta lows, and vice versa. So the highest high between 2 lows. So if you know this is definitely a point, because you can see it's going down for a good few days and then turns up, same here, you know those 2 points are definitely delta, then the highest high between the two must also be a delta point. Same as over here, which obviously tells us, like for example right here, there is a little high here and a little low here. That looks quite a significant low, so that has to be a delta point. But because we've got another delta point here, then there must be a high in between. There has to be. Now this is also a nasty area, because you're going to see this one other little quirk with delta, which is called the inversion, and it appears right here, because you can see this quite clearly in my eyes. As time goes on, when you start solving your own charts, you'll discover this. So let's start progressing and putting some more points in. Start with next point number 4. I'm going to place it there. That looks like a reasonable high. 5. That can go there. Put a 6 in. A 7. Point 8. Now another little rule to look at here. I could choose that point there and that point there. I'm not going to. I'm going to put the 8 there. Now why, you're going to ask me? Well, the other rule to look at, which again isn't in the book though, because there's a lot of rules I said to you earlier that have come along that I've discovered that aren't in the book and people don't know about, that make delta far more accurate. In between each of these periods of time, so don't forget, from this red line to this red line is the entire intermediate term delta period, but between each block you shouldn't have more than 3 points on average. Maximum is 4. You've got 1, 2, 3, 4. So between here and here, again, maximum is 4, but normally is 3. Well, if we already had 4 here, then this has got 1 really from this side, so there should be less in this side. Again, if there was 4 in this side as well as 4 in this side, then you'd have a massive move. So I'm putting 8 up there, and I'm going to put 9 here. When you go through this, just put the points on. You can put those 2 in, okay? So just put them in yourself, put 8 and 9 there, then 10 and 11 and so forth. Pick up all the highs and lows, and then when you look at the next section, you'll find you'll have a big move like this and a straight up move again, and there was no repeats. So then you can then rub these out and cancel these out. Oops. Right, point 10. We go here. Point 11. There. And point 12. There. Now that leaves these two positions. So that must be a 13, that must be a 14, but it's not the case. And the reason it's not the case is because if you look back here, there was a high here just before the red line, and then a drop till after. There's a high here just before the red line, and then a drop to just before, not after. So there's 2 extra points here, a low and a high, that have arrived that weren't here. Now you could turn around and say those 2 points were these 2 points here. There's a little one there and a dinky one there. But then you're going down to such small scale that you'd have a point here, a point here, a point here, and a point here. And that's 4 of them in such a short period of time. It makes it impossible. So what has happened? Well, this is what's called the inversion. Now don't worry, the inversion can only ever occur either side of this point 1. And what it is stating is as follows. If a high was here, as we're stating is a repeat of this point here, it would normally then go down to the point here. I'm looking at time here, don't forget, time. That is a straightforward down to point 1 and a straightforward up to point 2. What we're saying is from a high, instead of coming down to that point in time, it can stop halfway and then go up to the point to make it a high instead. This is what's happened here. It's come down towards the point. Instead of getting to where it should be in time, it's stopped halfway and turned up. Now, I've marked a point here because it represents the point here. We've also got the same situation after point 1. So again, once you've had point 1, it should come down to point 2, but instead it can also stop halfway and then go up to point 2. That is called an inversion, and that's called an inversion. So what it means is there's two inversions. It's a double inversion. So the market can come down, stop halfway, then go up and have the point, but it can also do it again the other side. Because normally from here we then expect this position to now go down to the point 2. Instead it stopped and went up. So reality is this point should be here. So I shall now move this there, and instead I'm going to use a bracket and put that there, another bracket and put that one there. So what I'm showing you here is from this point 12 we've gone down, turned early and made point 1, then come down towards point 2, but again turned early and shot up to point 2. So this particular solution has inverted twice. It's a double inversion, and you can see it clearly from here. We've gone straight down to a 1, nothing in between. There's a little wobble, but this point never went higher than this or never went lower than this, meaning because the delta says the highest high between two delta lows and the lowest low between two delta highs. So if this point had gone higher, then yes, that would have been an inversion point, but it didn't go higher. And from here up to the point 2, we never made a high and then made that point 2 a low, so it didn't invert there either. So there's no inversion here, yet here there's a double inversion. It's the only real quirk with delta, and it's not very nice, I know, but your best bet is if you're trading stocks and so forth, if something's coming to an inversion and you're not sure, leave it alone, go on to something else. The only real thing about this particular area is you'll also tend to find, not all the time, but tend to find the biggest moves will also occur around this point. So again, point 12 was the end of the series, because there's in here we've got 12 defined points, and as it came up to point 12 here, let's put a 12 in. 12, done. It then came down to point 1, but it came down rapidly. It's quite a big move in price. So the biggest moves will tend to occur either side of that point 1. And it did as a big move down, and it was a big move up. Well, all these other points are small moves. So the biggest moves do tend to occur either side of point 1. They don't always occur there, but they tend to. There are 12 points on this particular solution. So from this red line to this red line, there are 12 points, and those 12 points will repeat after this red line in exactly the same place, plus or minus a couple days, and they will always repeat. So I've seen there point 3 is a point 3 there. The next point 4 should also occur here just after the blue line. Then it will come down to a point 5, then make a point 6, which will be that 6 right next to the yellow line, and now it should be coming down towards point 7, which is here. So I can predict and put things further in for you. So here we go, point 7 continues. Point 7 should be about here. Haven't even put these points in yet, but I'm already saying there's going to be a low here. And then I can always put the next point in, point 8. Because once you've done one solution, you can copy it forward. That is a little bit before the green line, so I'll put it about there. Point 9. again just before the green line, we'd be about there. Let's fill these others in that are missing. 0.4, 0.5, 0.6. So we're already predicting the future by saying that there should be a low here, which it looks like the market is dropping down to it. Then it will proceed up to a 0.8 due here, and then a 0.9. Now let's go over those rules again. I want to try and make it as clear as possible. Between this red line and this red line here, this is, by the way, is the intermediate term delta. There will be a set number of highs and lows for the stock. This particular highs and lows, because it's the S&P 500 index, is exactly the same amount of highs and lows that are on all the other major indexes like the DAX, the FTSE and the Dow Jones. They're all representing the top stocks of their country. Things like the Nasdaq is not representing the top stocks, it's representing the top technology stocks. And technology is a different sector. So these points cannot be put directly onto the Nasdaq, but they can be put onto the FTSE, the Dow and the DAX. Now, even though the Nasdaq is an index, although a technology index, it will have similar positions. Delta specifies that the highest high is a delta point between two lows. So two delta lows, the highest high must be another delta point, and the same in reverse. So take this delta point and that delta point, the lowest low between those two must be a delta point. These delta points on the intermediate have a plus or minus of a couple of days. That 0.2 there, average was actually here, and it's come 2 days late because, like I said to you earlier, the bigger trend is up, the high points will tend to come late or on time, while the lower points on the uptrend will tend to come early or on time. So this 3 on average probably came somewhere around about this area or as late as here. Could come as early as here. And on an upward market, that's probably on time. It would normally come on time to 2 days beforehand. This 2 was probably normally due here, but because it's an up market, it's come a couple of days late. And if you look back here, you'll find there's a 2. And if you count backwards from this blue line, there's 1, 2, 3, 4, 5, 6, 7. There's about 8 days before that blue line. That gives you an idea, 8. Well, here it was 1, 2, it's only 3. If its average was here, which would have been 5, then between 5 and the 8 is basically 3 days. And it's plus or minus 2 days. So that's come early, and that one's come late. So there is this variance, and this is where people mess up a lot of times, because I'll see this point and I'll mark it in, and then I'll try and mark it in again there, and say, oh look, there's 2 extra points in between, all these must have been the inversion. It can be difficult, but once you've done it, once you've found the extra points, it is very, very simple. Now I put the 4 here, and when it's here it's only a few days, 1, 2, 3, 4, 5, 6, about 7 days after that blue line, while here I've got it 2, 3, 4, 5, 6, 7, 8, 9 days after the blue line, because its average was here. That's come a couple of days late and it's come a couple of days early. Now the defining rule does not state it's only 2 days. The average is 2 to 3 days. That is the average for one of these points on an intermediate term delta. In a short while we're going to be going on to the next time frame, which is the medium term, and that has a greater distance, but you also have a greater distance between these two lines. So instead of just a few days between each point, they're going to be running a few months. Right, so let's get rid of all these lines. Well, now let's go backwards a bit further. See, once you've got the history done, the future's simple, so you can predict the future positions. The future turns in time. Now here's the previous red line. We've got this 1 after this red line here, so we're looking for a 1 in the same area. Well, there's a low, so the chances are that's probably it, but it seems to be quite a distance in. That's a lot further than normal 2 or 3 days. So the chances are it's probably that high there, in which case there's probably another inversion around this area. So let's put the inversion, put this point in. There's a high there. The 2 has been here just before that blue line, and so there seems to be similar position there. That's probably the 2, that'll be the 3. So let's put those in. There's a 2, and we'll put the 3 in. So there is, remember, delta says a delta low is the lowest low between 2 delta highs. Well, there's 2 highs, so there has to be something there. So that has to be an inversion point. So again, we've just done those now. Now we can move forwards and fill the rest of this in. Now don't worry about going individually for each point. I mean, this looks quite clear anyway. What we could have done is just look at some obvious ones. So I'm going to put a 6 here because it's pretty obvious. That's right next to the yellow line. That's right next to the yellow line. Same with up here. It's actually touching the yellow line. So it's just before or touching it, it seems the average. So if that's a 6, we would have obviously known, because there's a 3, there's got to be a 4 and 5 in between. So I'll put these in. And 7. Now, if you notice, the 7, here it's come a couple of days after the yellow line. Here it's come a good few more. Its average is probably about here, but it's come late because there's a bigger downtrend, and you'll see this in a little while when we put the next time frame on. So it's come late. And there's your 8. Obviously a 9's next. And 10. And finally on this one, 11 there. So we've now solved a simple solution for that S&P, and this can now be put exactly on top of the FTSE or the Dow Jones. Everything you've done here to solve this is solvable on all the other time frames. We've just done it for a smaller time frame. This is the intermediate term delta. That red line to that red line repeats from this red line to the next red line. So there you go, from there to there is repeated. In between those 2 red lines we have found 12 definable points, and they will repeat from that red line across to the next one in the same place. Point 6 there is just before the yellow line. Point 6 just before the yellow line. Point 7 here is just after the yellow line, but it's an upward market, so you knew that point should be on time here or early on an upward market as a low point. And on a downward market it should be on time here or late, so you'd have discovered that would have been 0.7, so 7 and 7. Again up here we're now coming down to 0.7. Its average time would be roughly where the mouse is now, but if the market is now turning down it would come up to 2 days late, so it'll be on time or 2 days late. If it's going to turn back up again, then it'll be here on time or slightly early. Now looking at where this is, that's early, and that's a couple of days early before the yellow line. There it's quite a bit, so it should most likely be about here. That will be its average point, so we're expecting it probably to come about here or the following day after this last bar, so about here, and then it will turn back up. But if a bigger frame is in now, it will go down. Now what I mean by bigger frame is the bigger delta time frame. You will find that in a minute when we go on to the next time frame, which is a medium term, you will find lows and highs on a longer period of time, and when the longer periods are up, the lower time frame, i.e. intermediate, the highs will come late in that direction and the lows will come early. We'll go into this more later, so what we're going to do now is move forwards and solve the medium term delta. Right, so let's go across to medium term delta now.